Welcome back to the Daily Ledger, where we break down the most critical events shaping your world. Today, we're looking at why markets are in flux following the U.S. Iran peace deal. The primary driver for today's movement is the Strait of Hormuz, the world's most critical energy artery. As transit capacity begins to restore, oil prices have slumped, dropping toward pre-war levels as supply concerns ease. This energy dip is a double-edged sword. While it cools inflation, it's also clashing with a new, hawkish tone for Federal Reserve Chair Kevin Warsh. While lower oil typically helps gold, the Fed's signal of potential rate hikes is keeping the yellow metals upside in check, forcing investors to weigh cooling geopolitical fears against a tightening monetary outlook. Stay tuned. What a difference a deal makes. Look at these two maps of the Strait of Hormuz, the world's most critical oil choke point. On the left, we see tanker traffic as it appeared on May 14, 2026, before the U.S. Iran peace deal. The activity is visibly sparse. But look at the right side. This is the same region on June 18, 2026, just over a month after the agreement was signed. The contrast is staggering. Tanker traffic has clearly resumed and intensified significantly throughout the strait. It's a powerful visual indicator. Gold and silver are getting destroyed, with more than $2.5 trillion in value wiped out from precious metals in just the last 24 hours. Looking at the charts, gold has erased nearly $1.7 trillion in value, while silver has crashed over 11%, resulting in a loss of almost $800 billion. These are massive historic sell-offs that are shaking investor confidence across the board. As we see in the technical data, the downward momentum has been swift and aggressive. What does this mean for the future of these assets? And where is the floor for this crash? Stay with us as we track these developments in real time. We can observe a very distinct, sharp correction that has traders on high alert. The market is currently experiencing significant shifts, and understanding these technical patterns is crucial for anyone monitoring energy commodities. Technical analysis. Looking closer at the chart, we see a massive drawdown pattern. From early 2026, the price of WTI crude saw a significant peak, followed by a dramatic decline of over 46%. This massive sell-off lasted roughly 79 bars. Nearly 2 months of consistent bearish pressure. You can see the clear before and after scenario in this data. A rapid ascent followed by an equally sharp, volatile descent that tested critical support levels near the $64 to $65 range. Contextualizing the market, this wasn't just a random fluctuation. The chart labels highlight a specific before-war period, marking the transition from a relatively stable trend to one characterized by extreme volatility. For those of you tracking global economics, these visual indicators are vital for identifying when a market is moving into a new, higher-risk regime. Whether you're looking at moving averages or just raw price action, the evidence of a fundamental shift in market sentiment is undeniable. As we continue to monitor these developments, it's clear that the energy market is in a period of heavy repositioning. Keep an eye on these support zones, as they will determine the next leg of this trend. Thanks for joining me on the Daily Ledger. Stay smart, stay informed, and we'll see you in the next analysis. Subscribe to Daily Ledger.